If you lost your job tomorrow, how long could you keep paying your bills if your investments didn't send you a single rupee or dollar of cash flow every month? Most people don't like that question because the honest answer is not very long. But imagine this instead. Every Friday, like clockwork, there's roughly $500 of fresh cash hitting your account. And it's not coming from a boss, a side hustle, or a client. It's coming from a simple stack of 5 ETFs that you built over a few years, starting from literally zero. That is the $500 a week income challenge. And in this video, we're going to treat it like an actual mission. How much you need, which ETFs can realistically do it, and how long it takes if you're starting with nothing and just grinding out consistent contributions. Let's get the math on the table so you know exactly what game you're playing. $500 a week sounds like a random number, but it's actually $2,000 a month, or $26,000 per year in pure cash flow. If you earn 5% yield, you need around $520,000 invested to get $26,000 a year. At 8%, you need about $325,000. At 11%, it drops to roughly $236,000. That's why high-yield ETFs are so tempting. They shrink the target capital you need to hit that $500 a week mark. You're not chasing a vague million by retirement number. You're targeting a specific cash flow goal with a very clear price tag attached to it. Here's where it gets fun. There are actual ETFs on the market today that sit in that 10 to 20% yield zone by using options and volatility strategies, not just super risky junk stocks. SPYI, the NEOS S&P 500 High Income ETF, is yielding around 11 to 12% and pays monthly distributions. JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF, is also in that 10% forward yield neighborhood, again with monthly payouts. SVOL, the Simplify Volatility Premium ETF, has recently shown an eye-watering yield above 20% on its distributions. But before you get hypnotized by those percentages, remember, higher yield is never free. These funds are doing things under the hood, selling options, harvesting volatility, that trade off some upside or add risk in different ways. Your edge is in combining them intelligently, not just YOLOing into the highest number you see on the screen. So what does this ETF income machine actually look like in practice? Think of it as a 3-tier engine instead of one magic ETF. Tier 1 is your stability foundation. Lower yield, high-quality dividend ETFs like SCHD and VIG that focus on strong companies and dividend growth. Tier 2 is your income workhorse, funds like JEPI and JEPQ that use covered calls on broad indexes to push your yield into that 8 to 10% range while still tying you to big, recognizable names. Tier 3 is your yield booster, more aggressive plays like SVOL that lean into volatility or niche strategies to squeeze out double-digit yields. The suggested blend, 40% in Tier 1, 40% in Tier 2, and 20% in Tier 3. That way, you're not relying on a single aggressive fund to carry your whole $500 a week dream. Let's plug in some real numbers so this doesn't stay theoretical. Start with SPYI, which holds S&P 500 exposure and layers on options to generate a high monthly distribution. Its trailing yield has been around the high 11% area, with monthly payouts a bit above $0.50 per share at recent prices. At roughly a 12% yield, every $50,000 invested can produce around $6,000 a year in income, which is roughly $500 a month. So $50,000 in SPYI alone, if that yield level holds, can already cover a quarter of your $2,000 a month target. Now look at JEPQ on the NASDAQ side. This fund writes covered calls on NASDAQ stocks and has been pushing a forward yield north of 10%, again through monthly distributions. If you aim for $60,000 in JEPQ at roughly a 10% yield, That gives you about $6,000 a year, another $500 a month. At this point, with $50,000 in SPYI and $60,000 in JEPQ, you're at about $12,000 per year, or $1,000 a month coming in just from these two. You've already chopped half of the $500 per week challenge out of the way. Then comes the wild card, SVOL, Simplifies Volatility Premium ETF. This fund's current yield has been in the 20% neighborhood because it uses a strategy tied to volatility products and pays that out in monthly distributions. That's insane by traditional standards, and it absolutely shouldn't be treated like a savings account. But if you target, say, $37,000 into SVOL at a 15 to 20% yield, you're talking around $5,500 to $7,000 a year in income. That's roughly $450 to $580 a month. The catch is obvious. The higher your allocation here, the more you're exposed to strategy risk and potential cuts to the distribution if volatility regimes change. To offset that risk, you add the boring hero of this story, SCHD. SCHD has a yield under 4%, around the 3.5 to 4% mark, not flashy at all compared to double-digit payouts. But it focuses on high-quality U.S. dividend stocks and has a strong record of growing its dividend over time, which can be just as powerful in the long run as starting with a high yield. With SCHD as your anchor, you're not just chasing immediate cash flow, you're also building a base that can potentially increase your income every year, even if the market doesn't hand you huge capital gains. Putting it all together, here's the 5 ETF stack that can realistically get you very close to that $2,000 a month mark if yields stay within their current ballpark. First, SPYI at roughly a 12% yield, about $50,000 for $500 a month. Second, JEPQ at around 10%, about $60,000 for another $500 a month. Third, SVOL at roughly 15% or higher, around $37,000 for $450 to $500 a month. Fourth, a high-yield global or regional ETF like FEPI in the 20% plus range, about $22,000 for another $350 to $400 a month if that extreme yield holds. And fifth, SCHD at about 3.8%, your stability anchor, adding a more modest but reliable stream that keeps growing over time. If you're doing the mental math, that stack totals roughly $170,000 to $180,000 spread across those 5 funds. At the yield levels we're talking about, that kind of portfolio can throw off income in the ballpark of $1,800 to $2,200 per month. It's not magic. It's just the math of blending high-yield option strategies with a lower-yield, high-quality core. The trade-off is that these eye-popping yields might not be permanent. Payouts can move up or down as market conditions change, which is exactly why you don't want 100% of your capital sitting in the riskiest slice. Now here's the part everyone underestimates, the timeline from 0 to 500 a week. You might think this is a 15 or 20-year journey, but if you're serious about it, it can be much shorter. If you start from 0 and push $500 a week into this ETF income machine, that's $2,000 a month, $24,000 a year, and your blended yield across all these funds averages around 10%, you're not just collecting 10% on day one, you're constantly buying more shares, reinvesting the distributions, and increasing your contribution base every single month. At that pace, hitting the $230,000 to $250,000 mark, the range that can reasonably support around $26,000 a year at roughly 11% blended yield, can take something like 4 to 5 years of relentless consistency. That's not a promise. It's a rough path. Assuming you stick to the plan, yields remain in the same ballpark, and markets don't completely implode. But think about that. In the time it takes most people to finish a degree or slog through a mediocre job they hate, you could build an income engine that pays you $500 every week, whether you feel like working or not. The real challenge isn't, is this mathematically possible? You've already seen the numbers. The real challenge is behavioral. Can you actually commit to sending $500 every single week into this system, even when markets crash, even when that SVOL or FEPI payout gets cut, even when everyone on social media is flexing the next hot meme stock instead of boring income ETFs? The people who turn this into reality are the ones who treat it exactly like a job. They show up every week, they execute the plan, and they don't quit just because one quarter's distribution came in lower than they expected. Notice, too, that the tiers protect you from your own greed. Tier 1, with SCHD and maybe something like VIG, keeps you grounded in quality businesses with a history of paying and raising dividends. Tier 2, with JEPI and JEPQ, brings in chunky income but still ties you to large, diversified equity indexes. Tier 3, with SVOL and a high-octane ETF like FEPI, is where you get that extra kick. The suggested allocation, 40% in Tier 1, 40% in Tier 2, 20% in Tier 3, forces you to keep your riskier bets capped at a sensible level, while the majority of your capital is sitting in funds that are built to survive multiple market cycles. Here's a way to visualize the journey. Year 1, your goal is not financial freedom. It's simply to build the habit and cross, say, the first $20,000 to $30,000. At that stage, your income might be only $150 to $250 a month. It's not life-changing yet, but it's proof of concept. Year 2 and 3, your weekly contributions plus reinvested distributions start to snowball. You cross $80,000, then $120,000. Now your monthly income is 4 figures. By years 4 and 5, if you've actually stuck to the plan, your portfolio size and yield start to sync up with that $500 a week number. It doesn't feel linear because it isn't. The last 12 to 18 months of compounding and consistent investing do a lot of heavy lifting. Of course, there are risks you can't ignore if you're going to play this game seriously. Payouts on high-yield ETFs can and do change. SVOL's yield looks enormous today, but that's based on a specific volatility environment. If that environment changes, so will the distribution. Option income funds like SPYI and JEPQ can lag in bull markets because covered call strategies trade away some upside in exchange for steady cash flow, and none of these funds are a substitute for having an emergency fund or basic risk management. They're investments, not guarantees. That's why the rule of thumb for a $500 a week portfolio should never be max out the highest yielders. Instead, it's about using the high-yield names as accelerators within a disciplined structure. The Tier 1 core is where you sleep at night. The Tier 2 funds are where most of your income comes from. Tier 3 is where you accept that things might get bumpy, but you're okay with that because it's a smaller slice and you understand what it's doing. The goal isn't just to reach $500 a week once. It's to keep $500 a week coming in reliably for years. So here's the real question you need to ask yourself as you watch this. If you knew that 4 to 5 years from now, your future self could open their brokerage app and see $500 of income land every week, what would you be willing to do for that over the next 200 or so weeks? Because that's roughly how many weekly contributions you've got between now and that future version of you. 200 chances to either stick with the plan or skip just this 1 week. If you want to turn this from just an interesting video into your actual roadmap, start simple. Define your weekly contribution number, even if it's not 500 yet. Pick your 3 tiers, a stability pair like SCHD and VIG, an income pair like JEPI and JEPQ, and a carefully sized yield boost like SVOL, or another high-yield ETF. Set up automatic investments so that most of the discipline is handled for you, and then commit to adding manual contributions whenever you get bonuses, tax refunds, or extra cash. Track your monthly income, not just your portfolio value. Watching that income line go from $20 to $200 to $2,000 over a few years is one of the most motivating graphs you'll ever see. If you're ready to take on the $500 a week income challenge, here's your next move. Pick one ETF from each tier. Commit to a weekly number and write it down somewhere you'll see it every day. Then stay subscribed, because in upcoming videos, we're going to break down each of these ETFs in depth, run through sample portfolios at different starting amounts, and show you how to adjust the plan if markets throw you a curveball. If you found this breakdown useful, hit like, subscribe, and drop a comment with where you're starting from, 0, 5,000, 50,000, so we can build this income machine together 1 week at a time.